Hello, everybody. I am your mortgage lender, Rob, and welcome to 10 Minute Tuesday. This is a live and recorded video that I host every few weeks or so where I share real estate, mortgage, news, tips, hacks, and updates all in 10 minutes or less. So if you're watching this live and you have questions, drop them in the chat now or at the end. Or you can unmute yourself whenever I call out questions. But other than that, let's go ahead and get started today. The topic today is no-income home loans. First up, we'll always talk about a quick update on rates. I don't spend a lot of time on this, but generally rates are slightly, actually both of those are say up about 1/8%, so I have a typo there. But both rates are up a tiny bit in the last 4 weeks. But the part that you're not seeing if you don't follow the rates data today that I am, is that rates actually were up almost 0.75% a few weeks ago, and that was due to jobs numbers coming out strong. Inflation data it's coming down a little bit, but bottom line is the markets are really touchy right now, and any little bit of news that suggests more rate hikes sends the markets in a frenzy. We saw that a few weeks ago. Rates spiked real quick, but then they kind of came back down. So right now, the Fed meeting last week rose rates 0.25%. It was expected. There's not really a strong indication of a second hike this year, but it's probably going to happen. So we'll probably see rates continue to tick up, but the roller coaster will probably continue until it stops. So until then, hold on tight. I know I am. All right, the topic for today is DSCR loans and community loans. These are both no-income home loans. No income meaning your personal income doesn't matter. We'll talk about the differences between these two. The main difference you see right here is one is for investors and one is for owner-occupied. That includes vacation homes. So first up, the DSCR loan. This loan's making a lot of headlines or in the lending world over the last few years with the increase in the Airbnb purchases. What DSCR means, it's debt service coverage ratio. The income of the property you're buying must cover the debt, and there's a ratio we calculate to figure out your terms and down payment and rates. So it can be used for a purchase or a refinance, investment properties only. You must put at least 20% down, though I'm working on getting a program that might allow 15%. So these terms can change, and these are not Fannie Mae loans or FHA loans, so they're not uniform across the board from lender to lender. So you'll see some variance out there. You got to have a 620 FICO score. Higher credit score gets you those better down payments, like 20% down. At a lower FICO score, you may have a higher down payment. And you must have 3 to 6 months of reserves. Reserves is what you take your payment, principal, interest, tax, insurance, plus an HOA if it exists, and you multiply it by whatever's required. 3 to 6 months generally. I've got one program that does 9 months with better terms, minimum 9 months. So there's some flexibility there. And then finally, you can go up to 10 units for these. So normally you can go up to 4 units for a conventional FHA, VA loan. These programs go a little bit higher, but you can't live in the property. And the way you qualify is you qualify with the subject property rents. And we do have an option to use short-term rents. So without getting too much in the weeds, what that means is whatever the mortgage payment is, we look at the potential rent of the property, long-term or short-term rent. And then we look at the ratio. So you take the rent divided by the debt. So if the rent's going to be $3,000 and the debt is $4,000, the monthly payment, by debt, you're looking at a DSCR, the ratio of 0.75. And the higher your ratio, the better. Now, generally, you wouldn't buy a property that's only going to rent for $3,000 if the payment's $4,000. So let's say it was renting for $5,000 and the debt's $4,000. Now you're at 1.25. That's much better for you as an investor, and also from a lending perspective, you get better rates and terms. So that's in the nutshell how that one works. Rates are generally about 1% to 2% higher than conventional rates. So right now, as we're recording, conventional rates are about 7%, 7 and an 8. So we're seeing DSCR in the 8 to 9 range. Benefits: your existing debts don't matter. We don't calculate something called the debt to income ratio. You can close title in an LLC, normally with a primary resident or a property, primary or investment. Using conventional FHA, VA loan, you have to take title in your name or a trust in certain cases, but you can't take title as an LLC. This could matter based on if you're doing a 1031 exchange and you have to buy in the LLC, or just for whatever your reason is, you can take title in an LLC. It'll never hit your personal name. So that's a big benefit of the DSCR loan. And then there is actually a no ratio option where the DSCR, that debt service coverage ratio, doesn't matter at all with 35% down. So a lot of flexibility here for investor buyers. Let's say you don't qualify for conventional loans anymore. Your DTI is too high because you've recently purchased some things, or whatever the reason is. There's a lot of reasons why this loan makes sense. And I can offer it in a vast majority of the United States. Next up, the community mortgage. This is similar but different. It's for owner occupied only. So it can be used for, again, a purchase or a refinance. This is also a no income home loan. So purchase or refinance. You must live in the property. Vacation homes count, where you're committing to living in the property for 14 days out of the year. You got to put 20 to 35% down. That's the down payment ranges minimum we're seeing, largely depending on your credit score. Credit score is the biggest one, then reserves. You must have a 640 FICO score. At 640, you're putting 35% down. But once you're above, I believe it's 720. I could have that be off a little bit. But once you're in that 700, higher 700s, you can go as low as 20% down. This one you have to have a lot of reserves because you're not having any income to qualify, no rental income from the subject property, and none of your own income to qualify. You've got to show a large reserve. So same as that other calculation, full monthly payment, including HOA, times whatever the requirement is, typically between 12 and 24 months. So you got to have a large savings for this program to work. You can be a U.S. citizen, permanent or non-permanent resident, and it will work. Now, rates on this program, they're about the same as the DSCR, maybe a little higher. I was seeing closer to 9% last time I checked, and there's not a whole lot of opportunity to buy it down, though you can get in the mid 8%. So higher rates than conventional, but if for whatever reason you don't have income to show, there's a variety of reasons why this could be a good fit. It's a very simple loan if you're looking to purchase a house, and qualifying the traditional way is a challenge. So benefits, again, no proof of income, no employment verification, no DTI requirements. I think you're seeing a trend here. We don't look at anything related to your personal finances. We're looking at your credit score and your savings, down payment for reserves. So that's the community home loan. And then you can actually purchase this after you've had a recent bankruptcy. Usually you have to wait 2 to 4 years if you're going conventional. So a lot of flexibility there. And then finally, the down payment can come from a gift. So if you have family, close relative, someone who wants to give you a gift for your down payment, that's eligible. Though the reserves, I'm pretty sure has to be your own money. I could be mistaken on that part. That's everything. 7 minutes, and we are wrapping up. Any questions? Let me check the chat. I don't see anything. So I hope that was helpful. Thank you for attending, and have a great rest of your week.